Pandora is a retail company that sells jewelry. They are started in Denmark, but they've scaled internationally. This is their website. They make collaborations. They have made right now a Marvel collaboration. They are widely known all over the world. They have like 8.4 million followers on Instagram and do collabs with like famous actors and models and stuff like that. And the company right now is significantly undervalued. So first of all, I want to go here to Simply Wall Street, because Simply Wall Street helps us get an overview over a company. So you can see here on the snowflake, we have a nice green snowflake. This means they check a lot of boxes when it comes to valuation, future growth, past performance, financial health, and dividend. Here are a couple rewards that Pandora gets. So first of all, they're trading 50% below Simply Wall Street's estimates of their fair value. Their earnings are forecasted to grow 10.5%, almost 11% per year. That's a lot. And their earnings grew by 114% the past year. So people have been sent home. The company has done extremely well here the past year. That is of course not sustainable 100% year over year earnings growth, but 10% is a great earnings growth, and we're going to use that number in our stock analyzer tool here in a moment. You can see here, actually kind of funny, their main competitors is Apple and Meta. I don't really believe that, to be honest. Like the biggest thing that comes, the thing that comes closest is like the Apple Watch or something, and of course these luxury brands like Hermes, I don't know. So valuation, here you can see that they're undervalued. The fair value is like much above where they are. The future growth is looking great. 11% forecasted annual earnings growth. They have declined their earnings over the past 5 years. They have had this big boom here in like it's 2016, 17, and 18. That their revenue growth, their sales just declined, and the stock price did as well. So I'm not too familiar with the reasoning behind that, but it looks like they have come over that point and they are just looking to expand massively right now. I don't really want to get into more detail here on Simply Wall Street. I actually want to go here to Everything Money software. Amazing software. Go and get it. It's $30 a month right now. Yeah, Everything Money guys down YouTube. Shout out to them. I just bought it. It's amazing. So let's go here to the metrics first of all, because there are a couple things about this company that I absolutely love. And the first being, they have a very low price to sales ratio. That means their revenue divided by their market cap, that is 2.5. That is really, really low for a company with a forecasted 10% annual earnings growth. They have a dividend yield of 1.5%, and that dividend yield is easily covered by their cash flow, which means it's sustainable. Don't get caught up and buy a company just because they have high dividends, because there are things called dividends traps. They will trap you with their dividends and they can't afford it. 5-year average free cash flow has been 800 million. They pay out $150 million a year. That is easily affordable for them, and that is also why they can afford to buy back shares and blah blah blah. They have an extremely low PE ratio for a company that is a small cap stock. When you're looking at small caps, they will most likely have higher PE ratios because they have more growth. The bigger a company gets, the less potential growth they have ahead of them. So this company is a small cap stock with a $9 billion market cap, and that is why a 15 PE is just very, very low, especially when they are already seeing this amazing growth. So the thing that I actually like most about what we're seeing here, 50% return on invested capital. They are great at utilizing the money invested in the business. So that means when you invest the money, that will actually make a difference. 54% return on equity and 28% also incredibly high return on assets. They have a 52-week high of 141 and a 52-week low of $82, and right now they are laying to the low side of that. So, well, all this just looks very great. And let's go to the income statement here. We can see that revenue, they have of course had some bad years. That is why we haven't seen an incredible amount of growth here in the revenue. But still, we have revenue growth over the past 5 years, so that's a check mark there. We have down here, they are buying back their shares. You can see, let's go back 5 years, they had 110 million shares, and now they have 98 million shares. They're buying back their shares, and that is great because it's at a low price that they're buying back those shares, which means it actually makes a difference for you. Guys, if a company has 10 outstanding shares and you own one of them, you own 10% of the business. If they buy back 2 of those shares, you still have your 1 share, but that share is now 12.5% of the business. That is why it's important that the company is buying back shares, and also great that they're giving you that dividends, because you can reinvest that dividends and get even a higher stake of the business. Let's look at the balance sheet here. We can see here that their long-term assets covers their current liabilities, and it also covers their long-term liabilities, so they're in a good financial position. And look at the cash flow. We want to see this increasing, of course. They have increased their cash flow, but not a lot. Again, they have had some issues. Let's look at the stock price right here. You can see here they have had some issues with, the stock prices went down here. Why? Because their sales decreased and their revenue decreased, and it's now that they're back on track and started growing again. The 8 pillars, you can see they check all boxes except one, which is their net income growth. Again, because they had bad years, but that is no excuse. It is an X, so it is a 7 out of 8 pillar stock. This company, they have an extremely low PE ratio, lower than the 22.5 PE 5-year PE that we want to see. They have an exceptionally high return, 5-year return on invested capital. They have revenue growth. They have cash flow growth. They're buying back shares. They have bought back 13% of their shares over the past 5 years, and they have 5-year price to free cash flow is 11. So much less than the 20 that we normally seek to get. So let's look at the stock analyzer tool. So here I want to put in my estimates, my assumptions about the future, and that way we can get a price estimate for what should we be paying for the company right now. So here you can see that we have a 10-year that have grown 15%, but you have to think about that last year is baked into those 10 years, so that is of course pulling up the average. So I want to go lower here. I want to get some conservative estimates, and you can see over the past 5 years they have actually not grown that much. You have to think about it's going to get harder and harder to grow a business when it gets bigger. So that is why I want to be conservative, but still this is a small cap stock, so in 10 years, this is 10 years of analysis, 10 years, it is still not going to be like a humongous cap stock. So that is why we can go pretty high on these numbers at still 7, 9, and 11. And for the profit margin, I'm going to go 19 and 20. And for the free cash flow margin, I'm going to go 22, 23, and 24. And for the PE ratio, is a small cap stock, and the PE ratio is extremely low right now. So I would say like a 14, a 17, and a 20. And the price to free cash flow, or maybe I should actually pull this down to 13, 15, and 17. Yeah, let me do that. And let me do the same for the free cash flow margin. And I want to go here with the desired annual return of 12.5%, because guys, make it worth your time to invest in these individual stocks, because you could get a 10% return just investing in an ETF. So these assumptions are what I'm going to make about the company. Hit the analyze button. Green, almost, it's just incredibly green here, and I put a 15 PE here. This is actually extreme. I'm actually really excited about buying this company because it just looks like a steal deal here at the moment. Yeah, incredible. If you want a 12.5% annual return, then you should be paying, if you go for the mid here, if you believe in the mid estimates here that I made, you want to be paying $128 for the company. That 12.5% return will be baked into the mix. So that means not only do you get the capital appreciation up to 128, you also get the desired return. So if we want to see what the stock is actually worth, you should probably put in here a 10 instead, because here you get what the company is actually worth. You can see it's probably a double. Oh, I actually put the wrong number in here in the profit margin, so it's even better. Basically, all green company here, all green stock here, and I'm definitely going to be looking into buying this company. So that was Pandora, and holy smokers, it's looking good. So I want to also just take a look at here recommendation from the analyst, and they say it's a buy or it's a strong buy, and only a couple analysts say it's a hold. So yeah, the recommendation here is pretty clear. They are recommending it a buy, and their price target, average price target, is $900, 900 kroners, and right now it's at 600.